strategy on gold would you have favored at the start of the year? Would you buy on dips or would you advise to sell the yellow metal?
Well, gold is clearly out of favor. We've had a huge correction since essentially September 2011, and we think it might continue somewhat. The technical support at 1540 has decidedly been broken, and we could see it stabilizing. If you look at this whole formation, and from a chartist perspective, I would think we could see as low as 1200 before we actually see some stabilization.
Would you say that the Cyprus worries will lead to aggressive dumping for gold? If so, where do you see it by the end of 2013 or even 2014?
Well, the comments by Mario Draghi on Friday afternoon, 10 o'clock New York time, essentially started this whole move. You know, a large number of contracts were sold. He said that possibly Cyprus will have to sell its gold reserves in order to get a bailout. And of course, you could extrapolate that to countries like Italy or Portugal. Cyprus has only about 10 tons of gold. That in itself is not a market-moving event. But Italy has about 2,400 tons, Portugal about 380 tons. So if you take that into account, of course, you could paint a very bearish scenario if in the future gold sales are a prerequisite for a bailout.
Would this sell-off mean a defined shift to equities? And where do you see money flowing?
Well, equities have been driven essentially by central bank policies, not so much by fundamentals. You see what the Fed is doing. Now the Bank of Japan has started to jump on the bandwagon. The ECB has eased earlier on. So central banks have been behind the rally in risk assets, and that's where central banks want the money to go. They want the capital to go there. The theory being that rising asset prices will sort of jumpstart economic activity. Now, we do not necessarily see a connection between the falling gold price and rising equity prices. I think gold was maybe a bit oversold. We think the long-term bullish case for gold remains intact because central banks will continue with their QE policies no matter what, and at some point gold will benefit from that. But I think the biggest move from central bank-induced liquidity into equities have been seen, and we could well see a correction from here in equity markets.
How do you explain the outperformance of developed market versus emerging markets equities?
You know, in the developed markets, as I mentioned, central banks have been the major driver of equity prices, whereas in emerging markets, we're talking more about fundamentals that are driving the market. Now, in emerging markets, you have an exposure to the global economy. The global economy is not doing well. The US is growing maybe at 1.5%. Europe is in a recession. Japan is in recessionary conditions. So the external environment for emerging markets are not looking particularly good. And at the same time, you have inflationary pressure stemming from QE. So emerging markets reflect all that, whereas developing markets reflect central bank liquidity injections.